Hello, everyone. Happy Friday. Dave Keller here with the final bar on StockCharts TV. We'll talk about the S&P continuing to push to the upside. Look at the last 2 days. Strength on Thursday, continuing strength on Friday. What's interesting about today, triple witching day, right? So you have options expiration, which usually means heavier volume, and it's often tough to draw a lot of conclusions about the overall trajectory of the market based on what's happening today. The message of the market leading up to today: growth stocks working. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the technical analysis toolkit to better quantify investor behavior, better understand the markets from a structural and sentiment perspective, and focus on the message that the investors are providing back to us, or that the markets are providing back to us in the form of price action. A lot of fascinating movements to break down this week. There's been a lot of narratives at play in the course of this week. At the end of the day, the price of an asset, particularly the S&P 500, can be the best indicator of what's happening. Right? How are investors aggregating all of those inputs and translating that into buy and sell decision? You're seeing an overwhelming sense of strength over the last couple of days, with the S&P powering over the 4,400 level today, closing up at a new swing high around 4,463. We're going to break down all the different activity and focus on growth versus value, which has been a key theme for this week. We have great guests on the show. I had a lot of fun talking with people like Clint Cowles this week, Samantha LeDuc with some great perspective on what's happening. Next week, 3 solid guests lined up for you. On Tuesday, the 22nd, Peter Brandt. On Wednesday, the 23rd, Willie Delwich from All Star Charts. On Thursday, the 24th, Roman Bogomazov from Wyckoff Analytics. Also, our this 2022 edition of Chart Madness is happening next week on March 24th. 4 of us. We have a bracket of 16 stocks. I was just watching my Ohio State Buckeyes win in the first round earlier today. We will actually do a matchup of 16 of the largest U.S. stocks and pick our own brackets on what the best prospects are from a technical perspective through the course of the next 6 months. Tune into that, and you can check it out on stockcharts.com/chartmadness. Also, my next webcast through Market Misbehavior is going to be next Tuesday, the 22nd at 1 p.m. It's called 5 Key Charts for Market Sentiment. We'll talk about indicators like the VIX dipping back below 30, now down in the low 20s. We'll talk about survey data. We'll talk about put-call ratios, break down each of those indicators, a little bit of market history. We'll do a history lesson on what works and what doesn't in different cycles and what they are saying now. Go to marketmisbehavior.com/sentiment to sign up for that free event. Let's continue on with our first of 2 main segments today, what we call Wrap the Week. On Friday's show, we like to take a sense of what's happened over the last 5 trading days, look at how the big picture has evolved, and focus on some of the long-term trends that we can come up with. Let's start out just looking at the S&P's action today, and then we'll focus on the big picture and what's happening. The S&P 500 closing just about 4,460, up over 1% from yesterday. The NASDAQ Composite, though, leading higher, with the NASDAQ up over 2%. Mid-caps and small caps both up, but underperformed the S&P. And the VIX, which had been in the upper 30s not too long ago, now down to 24. So talk about a big reversal lower in volatility. On yesterday's show, by the way, we talked about the VIX, and I'm noticing on the chart, VIX over 30 so far in the last 3 or 4 months has been a fairly buyable dip. Now, the long-term trend has remained lower, and we're going to get back to that here in a few moments. Bond markets appreciated today, and interest rates come off. So while the 10-year yield was up around 219, yesterday's close down to around 215, but still, again, fairly elevated. Gold and silver prices lower today. Oil prices a bit higher. It wasn't enough to push energy stocks any further to the upside. They're actually flat, a little down for the day. But if you look at that sort of steady downtrend in gold, it's interesting. After the Fed meeting this week, Tuesday into Wednesday, the Fed minutes and then the comments from some of the Fed governors, starting with Powell and then some of the other governors over the last day or two, you've seen gold prices come down fairly steadily. Right now, if inflation is a big issue, you'd most likely expect gold to be heading in the other direction, heading higher. At this point, rotating lower. Now, what is working? Cryptocurrencies, all 10 of the most liquid coins that we follow, all up. You can look at the dramatic improvement in Ether, which is actually approaching 3,000, which is a significant big round number to pay attention to. Bitcoin, just in the hour we've been sort of getting prepared for this show, ripping above 42,000 and pushing to the upside. So both of those potentially breaking out of a bit of a range. We'll try to look at some of those here later if we have time to do so. Continuing on our Wrap the Week segment, let's look at the major asset classes and how they've evolved over the course of this week. So if you follow my voice and follow the mouse, I'll point out what each of these lines represent. And if you get lost in the upper left corner, there's a legend with each of the color-coded tickers. In black here is the S&P 500. So a pretty decent week for stocks. It's interesting that going into this week, you have the Fed meeting, right? And the first of what could be many rate hikes over 2022 and 2023. If you ask me what that it would tend to mean, the fact that the Fed is becoming much less accommodative and starting to be much more hawkish in terms of their approach to monetary policy, it would suggest to me that's probably a pretty big headwind to stocks in general, particularly to growth stocks. The opposite happened this week, and that what that might suggest is that all of that, less accommodative Fed is baked into prices already, and that brief pullback we've had so far in 2022 is enough to reset. I would argue, if you look at any measures of how expensive or cheap stocks are, I still don't see how, even given the pullback you've seen, you could argue that equities have fully priced in the reality of what the Federal Reserve is talking about doing over the next 12 to 24 months. I don't see it. Now, I can absolutely be wrong, and be clear. That has happened many times, and it will happen many times again. But I would argue that is a huge headwind, certainly for growth stocks. Now, what happened this week? The S&P up 6%, one of the better weeks since certainly in 2022, but for quite some time since we've been doing the show here. Decent week all around. What outperformed the S&P this week? You have emerging markets actually finished up 6.6%. In pink, we have the NASDAQ 100 with a fantastic week, up over 8%. The biggest winner of the week, Bitcoin, up almost 9%, 8.9%. As we're recording this. Everything else underperformed the S&P. Not too far behind were small cap stocks is the Russell 2000, which finished the week up 5.3%. Everything else was actually down on an absolute basis on the week. And these are sort of the non-equity asset classes you're seeing at the bottom. The dollar index down about 1%. Same could be said for bond prices, down about 1% as well. In brown, right here, we have crude oil prices. We're using the USO, which tracks crude oil, spot crude oil or the crude oil future pretty well. Down 2.3%, and the worst performer of the group, gold, down 3.2%. Now, obviously, the story of 2022 has essentially been, in some ways, this chart flipped over, and again, in some ways, with a stronger dollar and stronger gold prices for sure, starting to really materialize, and certainly crude oil prices being overall in a position of strength, and growthy stuff has been the underperforming assets. So this was very much a mean reversion week. By any stretch. The question, and you hear I described it as a mean reversion week. I was doing an interview earlier today and was asked about, whether or not this was the beginning of a huge recovery, or whether this was a bounce within a longer trend. Even just with, and we're going to go to the Mindful Investor Live chart list here as I'm saying this. Two of my guests this week gave very different takes on that. My conversation with Samantha LeDuc on Tuesday was talking all about value over growth and how there could be mean reversion, which you've arguably seen this week. But the larger trend is still value over growth, strength in commodities, et cetera. My conversation with Clint Cowles yesterday was more of an Elliott Wave perspective and seeing the recent pullback that we've seen as a pullback within a longer trend, and that we would most likely have. This was a big, sort of a wave 4 before a big wave 5 or some material, some sort of wave 5 that would push the S&P to new highs later this year. Now, again, but within both of those, suggestions, I think they both argue their case very, very well. I think there's a lot of room in a long-term perspective for short-term fluctuations that move against that thesis. And that's really what we've seen, right? As the S&P has sold off, I'm going to go to the daily chart here in a second. We'll go back to the market trend model in a moment. When you think about what 2022 has been, it's been a downtrend in the S&P, right? A move down and then a corrective or a corrective move back against the direction of the longer trend, the move lower into late February, and now this rebound that certainly we're seeing, even a bounce into early March, the bounce in or a move lower into mid March, and then rotating back higher. I would say the way I would answer that question is number one, a downtrend by definition is a pattern of higher highs, excuse me, a lower highs and lower lows. So when we take a step back year to date, it's been a clear pattern of lower lows and lower highs until the end of this week, right? And if you see the S&P getting above 4,400, that puts us above the most recent swing high, and that hasn't happened since late December of last year, which was the last time the S&P moved to all-time high. So at the very least, given the strength that we see going into the close this weekend, I would have to start labeling this as less of just a bear market rally, but a higher probability of it being more than that. And I think the question now is, what would be enough to, what would you need to see to give a complete thumbs up to the recovery? The fact that we're above 4,400, we remain above 4,400. I can't be that negative on the markets anymore, and I'm hereby claiming that. What would you need to see to turn fairly constructive? And I think we would have to get above a more significant high. I think we have to get above 4,600, which would take above this pink shaded area, take us above the February high, and that would clear the way to the S&P powering through to new all time highs. So again, the chart of the S&P obviously very fluid this week, and the only reason why I'm not pounding the table that this is a huge recovery is because today is always sort of a sketchy day. It's usually this sort of move. You'll have a lot of volume, and it was triple witching, which is when there's a lot of options that expire today. So a lot of stocks, the markets will move, and it's a lot of volume, and it's more of an artificial sense. It's not. It's not a pure directional, just a bunch of buyers came in and pushed prices higher. There are a lot of other forces at work here, which is why I would argue next week is incredibly important to see if we get that follow through. I think next week we answer this question a lot more easily. The first option is we continue this trajectory. We start to overtake previous levels. 4,400 becomes the new support level. And I would say, again, going into next week, that's the level I will be watching. Option two is this is the end of this move higher, and we rotate back below 4,400, and we continue this trajectory onto much further downside targets. I maintain the fact that I think 3,800 is still very reasonable. We start getting much further above current levels, though, and I'd have to say that that's not happening anytime soon, while it felt like it was a lot closer here about a month ago. So let's wait and see what's going into next week, what happens. Now, going back to the market trend model, this is my main market timing model. And again, this for me was created because I would spend a lot of time every week sort of going through a bunch of charts and thinking about their trends on different time frames. And I found that was something I could automate very quickly. And what's funny, I did a panel a couple years ago. It was actually in Kuala Lumpur, and I was asked to serve on a panel about man versus machine and talk about what humans are good at and what computers are good at, and how which was better was what we were asked to argue. In the end, we all sort of agreed that combining the two of them meaningfully would be most important. And this is one of the ways that I've been able to automate parts of my process. I have this model running on a bunch of different ETFs, which help me to quickly, at a glance, identify the trends in these different markets. So for me, the market trend model has three different time periods: long-term, medium-term, short-term. With today's move to the upside, which was really the last couple of days full of strength, pushes the short-term model back bullish. It has been bearish through the entire course of 2022. It turned bearish at the beginning of January. So this turning back higher is a bit of an interesting development for me. So right now I have long-term model bullish, medium-term model bearish, short-term model bullish. And that is exactly what this market feels like. That's why I like this model for me, because it sort of summarizes. If you asked me to visually tell you about the three timeframes, I'd say the long-term trend is strong, the medium-term trend is weak, the short-term trend is positive. And so I feel pretty good about that. The medium-term trend model turning positive is what I would need to see to be really thinking more risk on, broadly speaking. And I think an S&P above 4,600 would most likely allow that to play out. That's why I identified that level back on the upside. Now, when I've done interviews and on the show earlier this week and in recent weeks, and I've been asked about differentiating bear market rallies versus more constructive developments, for me, breadth deterioration has been a key part of the story over the last 4 months, really, right? Starting in mid-November, you can see that most of these breadth lines have been deteriorating. Some of them made new highs in January, but all of them rotating lower and making new swing lows over the last couple of weeks. What's interesting now is you maybe seeing some of these materialized, stabilizing a little bit. The mid cap advanced decline line actually just retook its 50-day moving average today, just barely on the close, sort of right there. The rest of these are still below. So they've all popped up a little bit, and these are not updated for today's close, by the way, yet. This is as of Thursday's close. So most likely, given the strength that we've seen, I think all four of these move up. I wouldn't be surprised if all four of them regain their 50-day moving average here based on the closing data today, which tells you going into the weekend, you're actually at the very least seeing these breadth conditions ceasing a downtrend, or as significant of a downtrend, starting to show some signs of stabilization. The last one, and then we need to take a quick commercial break in terms of breadth, is the percent of stocks above key moving averages. As of Thursday's close, over 50% of the S&P now above their 50-day moving average. A week ago, that was down in the 20%, 25%, really in the 20s, right? So we've gone about 30% of the S&P, that's not true, 25%, we'll call it, of the S&P over the last week or so had been below their 50-day moving average and now regaining the 50-day and breaking to the upside, just like the S&P is managing to do. So that tells you that things are starting to improve a little bit. This is the one I'd be looking for, and I'll be keen going into the weekend to see if we can get over 50% of the S&P members above their 200-day. That would be quite an encouraging sign, setting the stage for next week. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey, everyone. Thanks so much for joining us today on the Final Bar. Dave Keller here with StockCharts.com. We appreciate you tuning into the show every weekday after the close, particularly on Fridays when we get to wrap the week and focus on some of your great questions. By the way, your questions are really appreciated, and they all come from viewers like you just trying to make sense of these markets using charting and technical analysis on StockCharts. You can email us your questions at thefinalbar@stockcharts.com. You can tag us on Twitter on a comment at FinalBarSCTV. You can put a comment on our YouTube channel. Just put a comment below the video you're watching, and we'll gather all those questions in those places and hope to answer one of your questions live on the air in our next mailbag segment, Tuesday next week. Also, go to StockChartsTV.com. Those great interviews that I mentioned earlier this week with Samantha Leduc, with Clint Cowles, many other fantastic strategists coming through the Final Bar, and also great events like The Pitch, Chart Madness, and others, all for free on demand. StockChartsTV.com is our website, or on your mobile device, just search for StockCharts TV on demand. Let's continue on answering your questions from the Final Bar mailbag. As a reminder, thefinalbar@stockcharts.com is our email. Let's get to question number one. Hi, Dave. Where is the best place to invest once the downtrend is over? Really good question, and I'd love to tell you I know the answer to that, as I would hope I'd know the answer to everything. I will give you an educated guess based on what we're seeing. So a couple things, right? I mean, question number one is, once the downtrend is over, how do you determine that? And I think we've hit that pretty much every show. We've been talking about that, and if you catch how I talk to our guests that come through, if I can get that question in, I always try to. What would tell you that things are changing? Most of my guests have been fairly negative, as I've been, right? Because we've seen the deterioration so far. My question is always, what would you see that would turn you more constructive? Or if you are bullish, what would you see that would turn you more negative? I think that's a really good thing to think through as an investor. So if you are, thinking about a recovery and you're sort of bulled up right now and you feel really good about what happened this week, I would think about what would tell you that thesis is wrong. So always be thinking about the alternate, always be thinking about, the risk management side and what would tell you to change your positioning. Having said that, let's assume that the downtrend is over. Let's assume that this is the beginning of a return to new all-time highs, and the S&P hits 5,000 in the next couple months. I don't know if that's 100% likely, but it is certainly potentially possible. Absolutely right. So what would be the best place to invest? So I think the things to think about, I think it's a couple things. Number one, focus on the charts. And when I'm looking for charts that are working, while there's been a great bounce in some of the growth names, I don't want to downplay that. Charts like Tesla and renewable energy, things like Plug Power and others, with these great bounces off of previous lows, the FANG names starting to bounce a little bit. Super tempting, and I totally get it, but I have to go back to the larger themes, right? When you think about the Federal Reserve raising rates, when you think about what that usually means and what types of stocks tend to work, I would argue one of the big themes that we will all be dealing with for 2022 and 2023 are the prospects of rising inflation or challenging inflationary conditions, and higher interest rates. And there is one type of stock that tends to do much better in that environment, and they're not growth stocks, they're value stocks. So I would personally, I'm looking at energy, I'm looking at financials, I'm looking at healthcare, I'm looking at industrials, I'm looking at materials. Those are the stocks that tend to work. And again, the charts of like DVN that we talked about on the show yesterday, good long-term charts with brief pullbacks recently, but starting to reemerge potentially. Those are where I'm seeing strength. I could be wrong on that. I would focus on what you would want to see or what you would need to see on some of those growth stocks to turn more positive. But that's where my head is at for sure. Next question. Question regarding the short-term PPO and long-term PPO indicators that you showed in your last show. Do you only consider positions if the long-term indicator is bullish and use the short-term indicator for a potential entry? Really good question. I think you're referring to the market trend model that we certainly bring up every Friday on the show, and we've talked about fairly often. So again, I mean, to be clear, I don't use this as a trading system. I would never automate any sort of portfolio based just on this. Because for me, my process is very much a subjective process, a disciplined process. I don't want to say it's undisciplined, but it's certainly it's structured, but it is discretionary. What I mean by that is I don't have a quantitative model that's telling me what to buy or sell. I have models like this that are running in the background, but at the end of the day, they tell me which charts I should be thinking about. And for me, the main market timing model for me is this medium term model. If it's below zero, it tells me to be more cautionary, to think more about risk off. When the model turns more positive, that tells me to think more risk on. The long-term model are bigger structural movements, really telling you about secular weakness if and when that would happen. The short-term model is more of a placeholder, just giving me the read on the short-term environment and to help me think about the dynamics and what the likelihood is of the medium-term model changing. So the fact that the short-term model turned positive for me tells me it is much more likely that the medium-term model would turn positive here in the coming weeks. And it just tells me to start thinking about getting more of my risk on hat off. At this point, I still have a risk off hat firmly on my head, to be clear with you. So that's how I would use those 3 timeframes. Next question. Any suggestions on how to overcome bullish bias? For example, if you look at the S&P chart with the RSI indicator, at first you may think it is a bullish divergence and it's a buying opportunity, but diving deep, you can clearly see all the moving averages and trend lines are pointing downward. It's a really good question. It's actually from a couple days ago before this big bounce that we've seen, to be clear. But you asked about that idea, right? You have the bullish divergence, but you have all these other things headed lower. So first off, I would be careful because you asked about how to overcome bullish bias, which actually isn't a thing. What you're referring to, I believe, is confirmation bias, which is you're bullish and you start looking for bullish evidence, right? Or you look for evidence that supports your bullish thesis. And the same thing, confirmation bias can be bearish, right? And this is something I often have to fight because I learned technical analysis during a secular bear market in 2000 to 2001. Everything had been working and it stopped working. We had 9/11, and it was all about risk management and recognizing when charts were rolling over. So bear markets feel way more natural to me because when I learned technical analysis, that was the game. It was all about protection and risk management and using charts to minimize downside pain. So confirmation bias can cause you to be overly bearish as well, or consistently bearish as well. Having said that, your point was how do you manage that? And so I would say number one, focus on the evidence. Right? Don't approach a chart like this thinking I'm bullish or bearish. Now let me see what the chart says. Clear all that out and just look at the chart. And what can often help is take a piece of paper and just list out all the evidence, right? Here's the evidence that I see. What is the price telling me? What are the moving averages telling me? What are trend lines telling me? What are Fibonacci retracements telling me? What is the RSI telling me? I call that a technical checklist. I have 7 steps that I list out on any chart that I actually go through and answer those questions every time. I would encourage you to have a list like that you were reviewing. Having said that, I think you're absolutely right. One of the challenges I saw on this chart is a bullish momentum divergence, but that usually happens when the price is going lower. So my answer to that is that's encouraging. That tells me that a bounce is pretty likely, which we are absolutely seeing. The question is always the sustainability, and that's where we would have to, change some of those other indicators that you mentioned. Moving averages would have to stop sloping downwards and start to slope higher. The price would actually have to regain those moving averages and not just trading below them. We'd have to break above previous swing highs. We're arguably in the midst of doing that right now. I think next week, again, is going to be vital as to whether to confirm or deny that. Final question, and then we have to wrap the show. Do you prefer TLT, SHY, SLV, or GLD in CAD? That is a lot of tickers and acronyms. So to translate, do you prefer bonds, long-term bonds, short-term bonds, silver or gold, and all denominated in Canadian dollars? What's interesting is if you put all of them in Canadian dollars, it really doesn't matter a ton because you're taking the currency and you're putting the currency impact into all of those. I can't imagine I would prefer short-term bonds over anything, and long-term bonds I don't think are a great play given the fact that rates are most likely going higher. And that means bond prices are going to be struggling. Between silver and gold, I'd probably pick gold only because that's what I would usually use. But I would go for either of those over the fixed income instruments that you mentioned. Again, I don't think the Canadian dollar. I think if you look at them in CAD or in USD, I think it's going to give you a similar technical perspective in either case. Thank you guys so much for those questions. We appreciate them. Keep them coming, and we'll get to more questions next week. We need to wrap the show. Go to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P 500 breadth by cap tiers. We refer to this chart a couple times a week if we can. I have these all color-coded red. Before we started the show, I just was thinking, you know what? I might trip a couple of these to more neutral orange, and I didn't do it. And next week would probably be the time I would do that if we would rotate higher. I still see these as just one day at best touching the 50-day moving average. That's not enough for me to feel like this is a huge swing, but it certainly shows you how meaningful the bounce was going into the end of this week, right? I think the reaction after the Fed meeting, if you're bullish, you can write that off as, all right, all the negativity about the Fed has been priced in, all the negativity and challenges in Ukraine have been priced in, and now we're back to this bull market. I just don't feel comfortable declaring that yet in terms of the macro headwinds that I think are still very much there, but also in terms of the breadth. I think the breadth has bounced nicely, just like the market has. Next week, I'd love to see if there's a follow through there if I'm going to turn a little more bullish. Now, again, as I've always mentioned, I think when you're bearish, as I overall probably would still describe myself, you have to, I think, actively sometimes. One of the ways you combat confirmation bias, which is one of our questions was about, is you have to actively look for evidence or indications that disagree with what you might be saying. And I think the breadth in the technology sector is actually sort of a nice green shoot here. It's a nice bullish indication. The bullish percent index on the technology sector got back above 70%. That's actually called a bullish confirmation when the bullish percent on any chart like this is above 70%. That tells you at least 7 out of 10 technology members of the S&P are in an uptrend according to their point and figure charts. That's pretty encouraging. What's the problem? In November and in December of last year, you had a similar reading. We got just above 70%. And that was before the next sort of hiccup in technology shares started. That's, again, why I think next week is going to be vital to see if we get enough of a recovery. The XOK is really close to its February highs, but not quite getting above there yet. Today, we just closed above there. We'll see if we can sustain that. Finally, let's look at cryptocurrencies. I mentioned Bitcoin and Ether prices going higher, which is certainly impressive. I think I might be labeling this chart as a symmetrical triangle or a coil pattern. What that means, it doesn't matter a ton what happens leading into it. You then have this consolidation phase of lower highs and higher lows. And you can see these trend lines connecting those highs and lows. We can see the narrowing of the range around 2,600 to 2,700. That's the midpoint of this triangle. This is a pretty easy pattern to interpret because one of two things has to happen. You either break above the upper end, the upper bound, or below the lower bound. As of today, it appears that we're closing above the upper band. I would be very keen to see if Ether can power above 3,000 and the RSI can get above 60. Let's see if we can accomplish that over the weekend. Folks, that is our show, and thank you so much for joining us every weekday after the close for the Final Bar. As a reminder, all of our previous episodes at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.